You know, I was with a prominent developer in San Francisco not long ago, and he made the comment to me that there's 10 years in a cycle, and 6 of those years you want to be building apartments, 2 of those years you want to be building condos, and 2 of those years you want to be golfing. You know, where are we in all that? I would say that in the multifamily apartment development cycle, you know, we're getting reasonably deep into it. I guess I categorize it a few different ways. In the city itself, in San Francisco itself, the entitlement process is very difficult. So in order to get a site acquired and entitled, even if there's a zoning overlay plan that's been well thought out by the city, one may still have to go through 40, 50, 60 neighborhood meetings to actually get a deal approved and start construction. So the amount of units that have been developed and ground up in the city right now, it depends on whose numbers you're tracking. There's probably something like 6,000 units that either have been or will be built. But that's if you look at a city like Seattle, which is roughly half the size of San Francisco, it basically has a pipeline that's 2.5 times the size of ours. So in the urban core, it's limited. But to go back to your question, you know, I'd say you're well into, if it's a 9-inning game, you're probably in the 5th or 6th inning in terms of multifamily development. I mean, it's pretty full and on its way back, but because of the difficulty in getting entitlements, maybe that inning is a little bit earlier in the city itself, or at least it has longer legs. Maybe it's an extra inning ball game. In regards to condos, it's early. The first projects that were financed, there's only been about 5 condo deals in San Francisco of institutional capital size that have either broken ground or getting close to sellout. We've capitalized 3 of those 5, fortunately, Jones Lang LaSalle. One I can point to, the Marlowe, which was the first of those, is a project in San Francisco that's really beating its numbers in a very large way. And I think you'll continue to see that, all the projects that are coming out right now. The capital's hard to get still. Capital for condos. Condo's still a 4-letter word in the banking world. Only the very best sponsors with deep recourse are able to get low leverage financing. So the alternatives for construction financing for condominium developers, for essentially, you know, it's the same darn building as a multifamily, if you will, but rental, that is. But the financing structures are very different and much more challenging to attain. But it's early in the game, and there's a great need for capital there, and there's great opportunity based on today's prices without trending into future growth. Well, we've been quite active in terms of multifamily housing in San Francisco, particularly on the development side over the course of the last, call it 24 months. We have arranged both construction debt, mezzanine debt, and third-party joint venture equity for both traditional multifamily for rent product, as well as condominium development. As well too. That market has improved also substantially. It didn't naturally rise as quickly as the for rent multifamily market did in the beginnings of this cycle, but we've seen great growth in the last probably 30 months. There was an 18% increase in condominium values just last year alone, and a slightly bigger increase than that in our urban markets in 2013. So it's a very exciting time for San Francisco. It's a very exciting time for multifamily development, particularly in the urban core. Yeah, for acquisitions of apartments in San Francisco and in the Greater Bay Area, you know, it's a very competitive market. You know, most deals are selling in the 4 cap kind of range. That may become tougher if interest rates rise. Though we're at the end of we're at a period where treasuries have fallen back down by 35 basis points or so here in recent weeks or months. But recent weeks, really. So there could be some pressure on cap rates, and there's been a lot of growth in rental rates, and you know, I think most buyers maybe don't want to pay a 4 cap and not, you know, see future rent growth. So, but pricing has been tight, is expected to continue to be tight for a while. Product is again limited, and there have not been a lot of sales. I mean, there's particularly for larger institutional type of assets, the JLL is most active in financing. You know, there's not a lot of big institutions saying, hey, let's sell our apartments in San Francisco right now. Everyone wants to be there. So there's to some extent a dearth of product. You're starting to see some pre-sale activity, and you'll probably continue to see a little bit more of that. You know, one example of a deal that we recently closed with our partners from Chicago. Was for LaSalle, acquired a $102 million property south of Market in San Francisco in a very strong area, the Whole Foods market in the building, for $102 million at the beginning of the year. And we were able to capitalize that with a low leverage, very competitively priced permanent fixed rate mortgage at the end of this year. But that's one of the few stabilized, really high quality core multifamily trades in the city itself that's happened in recent times.